Governor Matthew Cranston from The Australian. Obviously, you look at underlying inflation to look through or ignore volatile items. But if you look at some of the business costs, energy prices, for example, up 47% this year without rebates. Wage growth, still a little bit higher than what you thought it would peak at from your last forecast and this one. And also business, the labour unit costs also pretty high, partly because of lower productivity. So the question is, what is the risk that business actually can't sustain those higher prices that aren't included in your underlying inflation? And might that restoke inflation later this year when business might have to increase their prices?
So I guess the first point I'd make is that this has been going on for some time, of course, high unit labour costs, high energy costs and so on for businesses, and we're still seeing inflation come down. So the outcomes are suggesting that inflation is still declining despite those costs that you're referring to. Second point I'd make is that businesses can put up their costs only if they're not going to impact the demand for their goods and services. So in a context of very strong demand, which arguably we saw coming out of COVID when everyone was out there trying to spend, then businesses have the ability, I think, to pass on costs. What we're hearing from our liaison is that businesses are finding that their margins are being impacted, so they are having to absorb some of the cost increases. So is there a risk that some of these cost increases could feed back into inflation as the economy starts to recover? Yes, there is, but we're judging that the signs so far and the evidence so far is that that's not happening, but we'll remain alert to it.